Welcome to ETFTV, your insight into the world of exchange-traded funds, issuers, and investments. I'm Margarita Harikova, and joining me today is Paul Lohrey, Managing Director, Strategy and Analytics at CRSP, and Deborah Furr. Welcome, Debbie and Paul.
Margarita, it's a pleasure to be with you today.
Great to see you, Paul. We all observe stock market movements from one day to the next. Are these just temporary fluctuations, or has the shape of the market changed over time?
So that's a good question, Deborah. What I think people observe in the market from one day to the next, they experience the volatility of the market. And of course, on one day, the market could be up 1%, the next day down 0.5%. And when you think about what we experience from day to day in the markets, they generally is not a lot of information content there. You look at the market over time and you kind of step above the daily oscillations and volatility that you see in the market. A couple of patterns emerge, and this actually goes all the way back to the early 1960s when some researchers at CRSP, faculty at the Booth School of Business at the University of Chicago, developed a database of stock prices that goes all the way back to 1925. And by doing so, what they made some very important observations from that data. One being that over time, stocks outperform traditional asset classes. Stocks outperform bonds. Stocks outperform cash. Stocks generate returns higher than inflation. These are important things for investors to be aware of as they allocate assets. And the other thing that was observed is that the stock market does change over time. So you see the number of listed stocks in the US equity market, for example, change significantly, and the shape of the market. And when I say shape, I mean the allocation of capital across the stocks that are listed in the market. That does shift, or concentration, levels of concentration do change over time.
Given market dynamics with changing numbers of stocks and shifting concentrations, how well have popular stock market indexes measured market performance?
Many of the popular stock market indexes that are often quoted today, you see, they did as good a job as they could back at the time they were launched. So you go back to the Dow Jones Industrial Average, which of course is the first widely followed index and is still in use today. That started in 1896. So in 1896, you think about the challenge, the technology challenge of maintaining a market index. First off, you didn't have computers. You had paper and pencil. So to keep your index to 30 stocks and to take, I guess, what some computationally might be some shortcuts like price weighting the index, those are features of the Dow Jones Industrial Average. You roll forwards, maybe half a century, then you see the creation of the S&P 500 in 1957. So in 1957, of course, that's the beginning of the era where computers were just starting to be deployed to measure stock market results and disseminate information about stock prices. Expanding that universe of securities from 30 to 500 was a big advancement. The other big improvement with the S&P 500, of course, is that it's market capitalization weighted. So it's not just the price of the stocks themselves, but the price of the stock times the shares outstanding for each component security. And when the S&P 500 was launched in 1957, it comprised about 95% of the total US market capitalization. So it actually was a pretty good measure, particularly for that era of the total stock market. Of course, as I mentioned before, the stock market does tend to change over time. And by the time you get to the mid-1980s, the S&P 500 coverage ratio drifted downward to about 75%, actually a little shy of 75%. So in 1984, you see a new index come into play, the Russell 3000. The Russell 3000, you had better computers in the 1980s than you did in the 1950s, more digitization of the information. It made following 3,000 stocks possible. And that 3,000 stock index was intended to represent 98% of the market. So even broader coverage than the high point for the S&P 500. Of course, you know, some people would say 98% is enough. Can you really improve upon that? And actually, you can. The issue you run in with some of these stock indexes is that they tend to have a fixed number. Well, they do by their name have a fixed number of securities in each, and as a result, they tend to be frozen in time in the way they were constructed. If 3,000 stocks was enough, you could actually turn to the Wilshire 5,000 and get 5,000 stocks. Although ironically, today the Wilshire 5,000 has about 3,300 stocks in it. So again, what I mentioned before about changes in the stock market over time in terms of number of companies coming into play there.
A better way to define the market in segments like large, mid, and small, rather than using fixed number of constituents? And why does that matter to investors?
With CRSP, we do believe there's a better way to measure the total stock market. And what you need is a framework that adjusts with the size of the market in terms of number of constituents, but also adjusts to reflect changes in concentration. So if you look at the CRSP Total US Market Index today, it represents by design 99.8% of the total capitalization in the US equity market. And that's roughly 3,500 securities. Even though it's less than 5,000, it's larger in terms of market coverage than the Wilshire 5,000 market. A couple things that I think are important for investors, particularly if you want to have something that measures the market consistently over time, is something that captures the market consistently over time. So, if you go back to the late 1990s, 1997, there were over 7,000 stocks listed in the US, something like 7,300. Today, the investable universe is roughly 3,500 stocks. So, you're talking about the stock market in terms of number of constituents halving. So if you anchor your index to a specific number of stocks, you don't capture that dynamic. And over time, as it turns out, you end up measuring something different over time. You look at a lot of investors who strategically select asset class benchmarks. When I say strategically select a benchmark, that benchmark should be consistent over decades. One thing I can tell you for sure is that I cannot predict the future direction of the stock market. I can't tell you whether it will go up or down from one day to the next. But I can tell you that, and I can't tell you whether a 1,000 stock index or a 3,000 stock index or a 5,000 stock index is going to successfully capture the full breadth of the market. But I can tell you that an index that's designed to capture 99.8% of the market will. So the CRSP US Total Market Index will increase the number of securities in the index, and it will reduce the number of securities in the index depending upon what market dynamics evolve over time or take shape. The other thing that's important is looking at segments. So the practice of defining market segments with a fixed constituency by count also creates problems. As I mentioned before, the S&P 500 at one point was near 95% of the total market cap, shifted down to 74%. Now it's closing in on 90% again quickly because the US stock market is getting increasingly more concentrated. That leaves very little room to construct a mid-cap and small-cap index of securities that don't overlap with the S&P 500. And the problem that creates for investors really relates or is the consequence of compression of mid-cap and small-cap indexes that become so small, it becomes a real challenge for institutional money managers to construct portfolios with meaningful assets.
Those are some interesting insights. Thank you for joining us today.
Thank you, Margarita.
like
Thank you to Chris for sponsoring this episode and to all of you for watching. To watch prior episodes and to see news from the ETF industry, visit us at etftv.net. Thank you.